When investors enter the stock market, they often face a fundamental question. Should you buy companies that are cheap or companies that are growing fast? This leads to two well-known strategies, value investing and growth investing. But what do these strategies really mean, and how are they different? Today, we're going to explore the key ideas behind value and growth investing. Welcome to Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. In our previous lesson, we introduced the basics of stock market investing. Today, we'll go deeper into two important investing styles that many investors follow. Let's begin by listening to our experts.
Value investing focuses on identifying companies that appear undervalued.
Indeed, these are companies whose stock prices are lower than their intrinsic value.
Value investors believe that the market sometimes misprices companies.
And over time, the market may correct that mispricing.
Growth investing, on the other hand, focuses on companies that are expanding rapidly.
Quite right. These companies may not be cheap, but they have strong potential for future growth.
Growth investors are willing to pay a higher price today for expected future earnings.
However, this approach often involves higher risk.
So, value investors look for bargains, while growth investors look for future potential. But how do everyday investors understand these ideas? Let's listen to Liam and Sophie.
I keep hearing about value and growth investing.
They are two different ways of choosing stocks.
So value investing means buying cheap stocks?
Not exactly. It means buying stocks that are undervalued compared to their real worth.
And growth investing?
That focuses on companies that are growing quickly.
So those stocks are usually more expensive.
Yes, because investors expect strong future performance.
Which one is better?
It depends on your goals and risk tolerance.
Now let's decode some important terms from today's lesson. First, value investing. This refers to buying stocks that are considered undervalued compared to their intrinsic value. For example, many investors follow value investing by looking for companies that are trading below their true worth. Second, growth investing. This focuses on companies that are expected to grow quickly in the future. For example, growth investors often invest in technology companies with strong expansion potential. Next, undervalued. A stock is undervalued when its market price is lower than its actual worth. For example, if a company is performing well but its stock price is low, it may be undervalued. Another important term is intrinsic value. This means the real value of a company based on its fundamentals. For example, investors analyze financial data to estimate a company's intrinsic value. Finally, risk tolerance. This refers to how much risk an investor is willing to take. For example, growth investing usually requires a higher level of risk tolerance. So, what's the key takeaway? Value investing focuses on buying cheap and waiting for the market to recognize true value. Growth investing focuses on future potential and accepts higher risk for higher returns. There is no single best strategy. It depends on your goals, your patience, and your risk tolerance. In the next lesson, we'll explore how to choose the right investing strategy for your personal situation. You've been watching Decode Advanced English on Wealth by Hana House, where English meets finance, investing, and real-world thinking. See you in the next lesson.